All right, happy Monday, everybody. We are back with another episode of Who Charted. With me, as always, Drew Wells, the team here at Research by Potomac, bringing you Who Charted. Drew has some updated digs coming to us for the first time from his new office, so it's exciting to see that. You know the drill here for the most exciting 6 minutes in markets. 6 charts, 6 minutes. Let's get after it, Drew. What do you got?
All right, this is stocks relative to bonds. This is the Vanguard Total Stock Market Index relative to the Vanguard Total Bond Market Index, right? So essentially, after going nowhere for a very long time, several months since Q4 of last year, seen this ratio broke out to the upside in the later part of March here, above a now rising 50-day moving average and a 200-day moving average. So the interesting thing about this is take a look at momentum in the bottom pane there, breaking out of that resistance level, testing it now as new support. So it's going to be a really key level to watch for equity bulls, we think, going forward into the future. This could provide, potentially some further fuel for gains.
All right, I couldn't resist the opportunity to pull some my cousin Vinny lines into technical analysis. So did you say Utes? What's a Ute? Bad joke, I get it. What's not a joke is this chart. This is the utilities index on a long time frame, right? And we had this kind of following the COVID crash, this consolidation, and we have a breakout now. 2 solid candles in a row as this extends to all-time highs. Everybody kind of knows the drill here. Utilities are a defensive area of the market, so the fact that they are doing well will probably serve as some catnip for equity bears. But what's interesting to me is that utilities are also a rates proxy, right? We all know what's happening with rates. They're moving higher, i.e. bonds are moving lower, but utilities are bucking that trend and working to the upside.
All right, this is a global region that we highlighted in one of our research notes recently, the Pacific ex-Japan. A lot of strength here. We've broken out of for $49 resistance level to the upside. Strong breakout above a rising 50-day moving average. Take a look at relative to equity ex-US right here, right? If you follow the international space a lot, you know that it's very difficult to find relative strength right now. And this is one of the few areas, few pockets and regions that you're able to find that strength. Broke out, retest, and go right there, right above a rising 50-day moving average of the ratio. Looks solid here. It's definitely one to keep an eye on.
All right, my second chart here is the U.S. Aggregate Bond ETF, AGG. All right, kind of a proxy for the overall bond market. For those who are interested in classical patterns, I guess if you wanted to make the case, there was a head and shoulders top there. I'm not big on that, but I realize some people are, so I highlighted the arcs. What's interesting to me is we are now getting down towards the 2018 lows. It's something that we highlighted in our monthly chart book. It's something that I highlighted in a note to clients this morning. If there was going to be a spot where bonds were going to start to rally, it stands to reason that we're getting close to it. Those 2018 lows, right? Even the lows post-COVID starting to come into play. A little bit of a reversal candle on the chart last week. I think if they want to pop, this is the place to do it.
All right, S&P 500 volatility here. Volatility by pretty much any metric that you look at still remains elevated. So we took a couple of different metrics here. There's a number of plus or minus 1% days in a rolling 1 month time frame. The horizontal line is 11, 21 trading days in a month. So anything over 11 is in the majority, right? So bottom pane here, we have monthly volatility measured by Bollinger Bandwidth, statistical measure of volatility. The higher up it goes, the more volatile the markets tend to be, right? So notice that pattern of higher lows throughout the last quarter of last year into this year. No matter how you slice and dice it, volatility continues to remain elevated. We did a deeper dive of this in a recent note on our public website. That dives a little bit more into the results. And generally speaking, forward returns for the market tend to be actually pretty favorable, following these types of events. The caveat to that is that, markets can always get more volatile, and it's something to keep in mind.
All right, so here is the curve, the yields, and the NASDAQ 100. Now, we were early in highlighting that a flattening yield curve with rising rates, otherwise known as a bear flattener, tends to be negative for the NASDAQ 100. That bear flattener continues to play out. except we've had a little bit of a rally here, a counter trend rally for the NASDAQ 100 over the course of the past couple of weeks. Something else that we highlighted actually on our monthly call when breadth was starting to improve for the NASDAQ 100, and we said it wouldn't be surprising to see a little bit of a pop here. Now we've seen that pop while the curve continues to bear flatten. So it looks to me like we could be in for a pause here for the NASDAQ as it kind of fights with a key level. Last week, it did bump its head on its 200-day moving average and promptly fade. So something to keep an eye on here is the curve along with the NASDAQ as it runs into resistance.
All right, everybody. Hope you like the new digs, and thanks so much for spending some time with us. And don't forget to like and subscribe. We'll see you in the next video.
All right, everyone. Thank you. We'll see you soon.
See ya.